The way to making wealth isn't by hitting grand slams. It's by hitting singles and doubles, constantly making money and as best as you can, and trying to mitigate the years that you lose significant amounts. What are we talking about?
We are going to talk today about how people tend to panic during market volatility. We're experiencing it right now. The tariffs are going on. There's a lot of market volatility. So what are some of the key factors you talk to clients about when it comes to market volatility and trying not to panic?
It's easier said than done, but at the end of the day, you don't want to be emotional. You want to think of why you invested the way you invested. Whenever we meet clients or potential clients, I'm trying to find out why they want to do a particular investment, if it's an idea they have. Typically, it's one of two reasons. They either want to have fun, right? They want to do in some exotic stock or put over concentration in NVIDIA now at these levels, or they're trying to make money for a goal. And if it's to invest money for a goal, it's important to remember what's going to give us the greatest chance of success to reaching that goal. And oftentimes it's putting up with the market volatility.
So I think you just touched on this, but what is one of the biggest mistakes that you see individual investors make when it comes to market volatility?
Well, the obvious big one is going to be going to cash or conservative after you had a significant loss in a portfolio. I think as a good advisor, what you should be trying to do, which is what we take pride on doing, is when we onboard a client initially and then therefore after in additional communication going forward, we want to get an accurate, realistic appetite for what their risk tolerance is. If they're not comfortable with 20% drop, say in the portfolio, we shouldn't have them positioned for that type of drop. Now, if they are comfortable and the market dropped and maybe their appetite for risk has changed, we need to have a discussion of, look, it might make sense more at this point to ride it out, let the market recover. And at that time, you become more conservative. I've had this conversation probably dozens of times in 21 years doing this, where the client says after the market's dropped, hey, I'm feeling uneasy because XYZ is happening. Why don't we go more conservative until this issue boils over? Mm-hmm. And then we'll get back in the market. That's not how it works. The famous saying that we hear in our industry is always from people is, this time it's different. In 21 years doing this, I can tell you it's not different. There's always a different reason for the market to come down, and it might feel different. Right now, we have the Trump tariffs. A few years ago, we had COVID. In 2008, we had the fiasco with securities debts. We had the .com. There's always a different reason for market volatility. At the end of the day, the reaction should be similar in terms of, are you diversified? If so, the price of admission to make more than you can, say, in a CD or a 10-year treasury, the price of admission to make higher returns is paying into bad times. We always tell clients, 2 out of 10 years, you're going to lose money. The function is what we try to do is figure out the recipe. How much money is that client comfortable losing in those 10 years? If it's not that much, we dial down the risk.
Okay, so I want to pivot because this is a fun topic, and I know you're going to love it, or maybe you'll just hate me for this question, is what's the biggest stocks out there that people are starting to dive into? There was the GameStop fiasco, but then you have NVIDIA. You brought it up a second ago. If you're okay with volatility and you're not going to panic, why wouldn't you just put all your money in NVIDIA or something like that? How would volatility play an emotion in buying individual stocks in huge proportion like that?
When you invest significant amounts of money in concentrated positions, which let me give you a long-winded answer. The S&P 500 right now, about a third of it is the Magnificent Seven, right? NVIDIA, Facebook, Google, Amazon, Netflix. And that's a big deal because that's somewhat of a concentration right there. And sometimes people say, well, the market's expensive. Well, what market are we talking about? What sector? If you're looking at the whole S&P 500, perhaps it's a little bit expensive, and I would argue it's concentrated. But we want to be aware of what risk we're taking. The risk you're referring to is concentrated risk, is what I'm hearing you say. You're saying, hey, if I have half my money in NVIDIA, what's wrong with that? For the record, NVIDIA is in our portfolio, so I'm not anti-NVIDIA, but it's one thing to have maybe 1% of your money in NVIDIA and another thing to have 50% of your money in NVIDIA. One example I talk to clients is in terms of return, right? Imagine you have $1 million and you lose 50%. Now you have a half a million. The following year you make 50%. You have 750K. Yet somebody or some document may try to convince you that you're averaging zero rate of return, right? The reality is you had a million 24 months ago. Now you got 750. I would argue you're down 250K. So the losses are more important, I think, than trying to capture every penny you can on the upside. It's just as important, if not more important, to mitigate the losses. Even if you are an aggressive investor, you want to be what I would call intelligently aggressive, meaning not overly concentrated, not in marijuana stocks if you're into that, but you want to be intelligently diversified into stocks that the likelihood of them going to zero is slim. Now, the likelihood of them 10xing in 12 months is slim, but that's okay. The way to making wealth isn't by hitting grand slams. It's by hitting singles and doubles, constantly making money and as best as you can, and trying to mitigate the years that you lose significant amounts.
Now that reminds me of, I know one of your favorite quotes from one of your favorite investors, Warren Buffett, talking about why risk money you need to make money you don't need. And it all goes back to diversification. Let's rewind the clock.
Well, let me for anybody
Sure. Go
listening,
ahead.
let me make sure the quote is, it's foolish to invest money that you don't need to make, I'm messing it up. It's
right.
foolish to invest money that you need to make money that you don't need.
Right.
Let's say you have $3 million. You need it. All financial goals are set. Why would you invest it in a manner that you might get 20 million in 5 years, but that 3 million could go to zero? That's ignorant. That's foolish. Yeah.
So great. Now let's rewind it. As you know, we're meeting clients or potentially new clients every single week, and most of them lived through 2008. The Great Recession. However, since then, many still have some wounds for what just happened just 3 years ago. 2022 was the worst year in the stock market since 2008. We're meeting people that have come from other financial institutions. They're down 25, 30, 35%. All depends on their allocation and how they're invested, I know. But they're still licking their wounds from that type of downturn. Now, I know this answer, but in 2021, there was some news that came out that we started to notice. How do you pivot when you see that market volatility? The worst year since 2008, people are truly panicking. It's not your standard correction. How are you pivoting? What are you doing to protect your clients in those years?
I could answer that in so many different directions. So I would say typically our clients have stocks and bonds, right? Some of our clients only have stocks, but most people that we work with, they're not comfortable with maximum 100% stock portfolio that is extremely volatile. So let me start with the part of the equation that has to do with fixed income. In 2021, there are signs that, hey, we're going to have a little inflation. We think interest rates are going to go up, right? You said you knew the answer, so I'm assuming this is what you're thinking too.
It was a fun time.
In 2022, we started to shorten the length of duration. Duration is a fancy word for length of maturity of a bond. We shortened them on bonds.
Why?
Thank you for asking.
You're welcome.
Interest rates and bonds work inversely. What I mean by that is if interest rates go up dramatically, your value of your bonds most likely are going to go down. Now, let me answer that and then I'll rewind it back. So if you have, say in 2021, you're in a CD or you're in a 10-year treasury, 10-year government bond, say they're paying about 1.7% at the time. So you give the government $100,000, they're giving you $1,700 back per year, right? And after 10 years, you get your $100,000 back. Well, if interest rates spiked, which they did, now that instead of finding a CD or a 10-year treasury paying 1.7, now you can find them, say, paying 4%.
That's great.
It is if you have money to invest, but if you've already invested it, making 1.7 and you're locked in, your $100,000 now, it could be worth $92,000, maybe less.
But why? Because it's guaranteed.
Because nobody on earth is going to pay you $100,000 when yours is paying 1.7% per annum, when they could buy an identical one paying 4%. Right? Now, somebody may say, well, Glenn, what Glenn's not saying is you would get your 100 grand back. You would after the 10 years. If you invest in a 10-year bond paying 1.7, you get the $1,700 a year and your 100 grand back at the end. But in the meantime, you missed out on other people having invested at 4%. And on paper, when you're looking at your monthly statement, your values of your portfolios will be dropping. And as you know, we had a ton of clients calling in and saying, hey, I have this other account in my 401k, and I even have it more conservative than with you guys, and I'm down more. Why is that? Well, they were in long-term bonds. The worst investment in the world to be in when interest rates are going up, especially if they're going up rapidly, are long-term high-quality bonds. What's long-term? 7+ years, so 10 years would be a good example. What's high quality? U.S. government debt. That's AAA rated.
That sounds like the best thing.
Not if it's the best in times of volatility.
Mm-hmm.
In times of rising interest rates, it can be hectic. You can lose 5, 10, 15, 20% depending on the particular bond.
So let me ask a question though. So in 2021, where were interest rates, and what gave you the feeling that they were going to rise? Did they have room to rise?
They were historically low. That's a great question. Thanks for teeing me up there.
You're welcome.
So the main thing the Fed can do to fight inflation is what? Raise interest rates. We've had inflation creeping up, and even during COVID, it was at 9%. So the Fed has several mandates. One is to keep unemployment low, to keep us Americans working. Another is to keep inflation down. The main thing that a Fed can do, if you remember several decades ago, Fed Chairman Volcker, he did the same thing. He raised interest rates dramatically to bring down inflation. And we didn't have that type of inflation during COVID, but it's still pretty high. We hit 9%. So if you know there's signs of inflation, they're printing money like mad, they're giving all these government subsidies, if you will, you know it's going to create inflation down the road. You don't know exactly when. You can't point out the month and maybe not even a year, but you know it's going to come. So to prevent that, what we did in 2022 is we shortened those bonds, right? Now, at the time, some clients were saying, well, why are we making less on these bonds in income? Because if they're paying 1.7 on a 10-year, and if we're in a 3-year, maybe it's paying 1. Yes, we know we're making less in income while we hold it. However, as it goes along, if interest rates go up, we're not going to be exposing ourselves to a dramatic loss in principle.
Thank you. And real quick, what about the stock side of that? What were y'all doing in stocks
Yep.
back then?
I'll give you 20 examples. I'll give you the first one that jumps out of my mind. We bought Salesforce. We've had it for many, many years. And 2022 is one of the worst performing stocks in our portfolio, one of the worst performing stocks in the S&P 500. And what did we do? We looked at the fundamentals. Is Salesforce still a company that we want to own? Is it good? And the answer is yes. So what did we do? We kept buying more and more shares of Salesforce. And then that allowed us to do two things. One is in 2023, it was one of the best stocks of our portfolio, Salesforce, in 2023. But in addition to that, it allowed us to do tax loss harvesting. Many firms...
What is that?
Great question.
Yeah.
Many firms don't do this. They don't have the bandwidth. I'm not going to name names, but many giant institutions, they'll put you in an investment, and if it makes sense to buy more of that because it's low, their fingers typically not on the pulse in that manner. And if they do like that stock, they just ride it out. What you want to do is tax loss harvest. And what that means is in the same scenario, let's say you buy a stock at $100 and it comes down and it comes down to say to $70. Maybe you buy another share at 70 and now you ride it up to $90. That initial cost basis, the initial position you sell, you get the tax write-off from the 100 to 90 that you sold, but now you reposition it with a brand new stock. So you still own the position and you gave yourself a tax write-off. These are things that you have to be at a firm that's nimble enough, that has the bandwidth. Oftentimes I'm asked by clients, well, why didn't my previous advisor do that? They're not trying to be mean. I'm sure they're doing their best, but you have to have the technology to do it. You have to have the bandwidth to do it. Some of it's not about lack of integrity. It's about lack of resources and lack of just wanting to always do like we do for our clients. We're trying to do more and more and more for our clients, and some people are just asleep at the wheel, I think.
Yeah. No, that's great information, especially about the tax loss harvesting, because people don't talk about it. Last question, real quick. I know how big financial planning is to us at GDS. It is literally one of the bedrocks of the success we've had because we only work with clients that allow us to do complementary financial plans. And then diversification, especially in times of market panic and volatility, is important. So just tell us about market volatility, financial planning, diversification, how financial planning and diversification play a key role in market timing and panicking.
And that's the main reason I love to do financial plans for our clients, because it allows us to bring the future into the present. And what I mean by that is when we show somebody a financial plan and we can talk about, are you comfortable with a 10% drop, a 20% drop, a 30% drop? At what point is your level? And it's different for everybody. And this allows us to have this conversation now when we onboard a client or once we've had them as a client, but while we're in a good stock market. What you don't want to do is just be asleep at the wheel. The market deteriorates, and then you wake up to realize, wow, I'm not comfortable with a 10 or 20% drop. You want to figure that stuff out while you still have your principal, not after you lost 10 or 20%. So I would say the financial plan is a key, as you know, for us. It's just like a doctor. You'd hope a doctor would do an MRI before they do a surgery on you, or at least an X-ray, right? Before they put a cast. I'm shocked of how many times we run into people who have a portfolio, who have an advisor, yet it's a hodgepodge of things and there's no plan. There's no plan of action. We don't know. And it's hard to make recommendations in terms of how you should invest your money. Should you do a Roth conversion? Should we change anything with estate planning? How do you even know that when we have no MRI? You're totally guessing.
Have the hard conversations before it happens.
That's exactly right.
So if you had one key takeaway for everybody when it comes to panicking in times of market volatility, what would that be?
It would be twofold. I can't give you one answer. It would be twofold. One is look at what you have in the good times. Okay. Don't just assume because you're making money, it's set. An example of a gentleman we saw recently who had 100% of his 401k, millions of dollars in NVIDIA. You want to discuss that now. Are you okay with that? And what's the upside and what's the downside? Are you comfortable with that? The second thing is, if you're already in a market where the market's dropped 20%, you want to take a deep dive in is this portfolio still diversified? Because it could still come down further. And are you properly set up, more importantly, for the recovery? Not if, but when. Typically, when a stock market comes down, it's different every time, but it typically takes 9 months, maybe a year in some situations for the stock market to recover. So you want to be in a position where if you got your butt kicked on a downside, at the very least, you recovered on the upside. So not to do anything emotional. I know it's easier said than done, especially when you're looking at your portfolio if you've lost a chunk, but you want to make sure you're giving yourself every possibility to recover in an intelligent manner.
So my takeaways are stay calm and don't let emotions make you make poor decisions. Let common sense and knowledge lead the way.
Absolutely. And actually, I'll throw one more at you.
Sure.
That's somewhat related. I'm a huge Warren Buffett fan, but he talks about 3 things that you always want to be careful with when it comes to protecting your net worth. And
I think I know where this is going.
It's not really related, but you made me think about it.
Yeah.
And the 3 things you have to be careful with: ladies, liquor, and leverage.
Nice.
Those are the 3 things that leverage. What does that mean? That means that means leveraging your account, on margin, or some type of options where you're leveraged up. Right.
I love it. Great quote. Well, perfect. Before we end, we had a good mail-in question, and I think you're going to love this. I had a chance to go ahead and look at it. What is one common piece of financial advice you hear often but actually disagree with, and why?
Man, you should have given me this earlier so I can think about it. There's
know.
a lot that I disagree with, but sometimes I think it's the one that jumps out at me, especially lately with some disallocations in the stock market. I think the one I'm disagreeing with lately is some clients have made some money, but not doing it the right way. They've had way too much money in certain stocks, and they've had amazing performance, but now they think that's their next year is going to be the same thing. And, they quite frankly maybe had some luck, or you could call it a blessing or whatever, but that's not, people win the lottery every day. That doesn't mean it's skill. So you want to be very careful. I think it's the over concentration and how much sometimes people attribute skill when it's really luck that they had in building that portfolio.
Yeah, perfect. Great answer. Great question. I held it for you just in case. So
Thanks, Robert.
great. No, I appreciate it. Thanks for the time.
My pleasure.
Yeah.